Despite fears otherwise, the U.S. is still the place to be, forecasting a stronger dollar with a year-end price target of 6,600 on the S&P. Darrell Cronk is here at Post 9, Wells Fargo CIO for Wealth and Investment Management. It's good to see you, Darrell. Welcome
Thanks,
back.
Carl.
So that's close to a street high, is it not?
There's still some numbers actually in the 68, 69, 7,000.
Right.
But it's aspirational now with where we are at 5,750, 5,800.
Has there been a temptation to cut either your target or your earnings target?
We've looked at it. I mean, we've reset multiples down a full 3 points, which is nice, right? But the question is how much of that reset comes with earnings reset. So far, we haven't seen it at this point. In fact, most industries and sectors have not adjusted their 2025 numbers hardly at all at this point. Now, most of that, in fairness, most of that adjustment for full year comes in Q2, so it could lie before us. And certainly, as many have talked about, and we agree with, the soft data has been extraordinarily weak, so the transmission mechanism into the hard data will matter. I do think company CEOs and CFOs are becoming more concerned about just the spend and the hire side of it, right? They're playing a little more defense. They're looking at ways they can protect margins and protect that earnings growth. But remember, we're coming off a quarter where we had 15, 16% earnings growth, right? And I still think you can pretty easily get to a double-digit earnings growth unless, April 2nd and the tariffs really become, an inflection point for the economy.
Do you think that Europe outperformance has topped out relative to the U.S.?
We've been looking at that hard, right, in the strategy committee. History tells you for Europe to sustainably outperform for any period of time, you need a sustainable period of weakness in the U.S. dollar. Dollar has weakened meaningfully from, call it a peak 110 on the Dixie down to 103, 104. We actually think it's probably gone too far. And you need earnings to deliver in Europe, right? And so if earnings are delivering in the U.S., they're not delivering in Europe. No, regardless of defense spend, regardless of even some of the news coming out of the U.K. this morning on more robust welfare spend and all that stuff. I mean, there's spend going to happen there, but it needs to transmit itself into the fundamentals.
What about the idea that we're in a transition period, as we were just talking about, federal spending cuts, tariffs, and rebalancing of trade, all the stuff I was just talking about. How long does that take, that period, where you can look potentially to the other side where those investments ultimately are pro-growth and worth it?
How long does it take to run through the supply chain or the value chain? It's probably at least, fourth quarter of this year and maybe first quarter of next year. I mean, in a lot of ways, if you want to compare.
So is that how you should think of growth this year? We know it's going to be a weak first quarter because there's been some tariff distortions. Second quarter probably too, and then.
Weak on growth, but not necessarily weak on earnings, we don't think.
Oh, okay.
Right? So we still think earnings will deliver. But the narrative has shifted in the sense that Europe has now become the U.S., right? The U.S. exceptionalism, and everybody loves Europe, and we've pushed that trade. And the U.S. has become in large part Europe, right? Because we're concerned about tariffs, we're concerned about fiscal contraction and all this stuff in the narrative, right? And in some of the positioning. And we think that's overblown at this point. We actually think the markets can rally from here, right? And hence our targets. And we think fundamentals can actually deliver. I've got my eyes close on April 2nd, and I think what will matter there is the autos, pharmaceutical, and semiconductors. If you add those three industries together alone and look at the amount of U.S. dollar imports, it's $1 trillion of our $4 trillion imports. So it's 25% of our total imports. So to the degree to which there's meaningful increases in those industry or sectoral elements, I think is a wild card here that we have to pay attention to.
The only last thing I'd add is the corporate commentary we're going to get on Q1 is going to come days after April 2nd. I mean, these CFOs are going to be commenting in real time.
Yes. And so what I think you'll see is not necessarily that impact in real earnings, but you'll see it in pullback in wanting to finish through with that CapEx spend for 2025. And maybe not the hiring like we just talked about, right? The labor market's still resilient, although we do think the unemployment rate ticks up to 4.8, so just under 4.8, yes. And we're on the high side of that for this year, but we see that coming through in growth slowing at the economy level, obviously some of the federal layoffs, and we just think companies are going to be reticent to want to robustly hire in that environment. So it's not so much that you get these massive layoffs, we just think the hiring is going to be anemic.